is of considerations for me, right? So you got this week. Today, don't need to worry about too much today. Today is never going to be much of an action-packed day when we have got all of this out the rest of the week. So we come into tomorrow. Right, tomorrow you've got GDP figures out of France, you've got GDP figures out of Spain, you've got GDP figures out of Germany, you've got GDP figures out of the Eurozone as a whole. Right, these are the flash estimates, which are the first estimates you get, but ultimately they are still pretty backwards looking indicators. Right, they are looking at Q2. Right, so the fact that looking at Q2 means it's not so important, but it is still a data release that we do need to pay attention to. Right, we then have inflation figures out of Germany on Tuesday, and I can't imagine really any of this stuff having too much of a shake-up on markets, just simply due to the fact that we've got bigger fish to fry really than that one. Right, one, it's a backwards looking indicator, and two, we got more important things to look at over the course of this week. Right, you then got these job openings figures. Now these are not too widely looked at job openings figures because they are what they say they are, job openings, right? So ultimately, if there's jobs open, positions available in America, right, if there's more or less positions, right, technically speaking, more positions being open is a positive, less positions being open is a negative, right? But ultimately, we don't really know where those positions have come from, right? If there is more positions open in the US, is that because we've seen a bunch of layoffs, or is because there's generally more jobs available, right? If job openings pushes lower, right, there's either less jobs available or more people are in employment, right? Primarily it's because, if it come in higher, well, there's more jobs available because businesses are hiring, right? If it comes in lower, there's less jobs available because businesses are not hiring, right? So it's kind of how you'd interpret that, but again, it's not the main focus of this week, right? We then come into Wednesday, and Wednesday is an action-packed day to say the least, right? You have got straight or first thing in the morning, so first thing in the morning is 2:30, you get Australian CPI, right? The Australian central bank is the most hawkish of all the central banks at this point in time. At the last two meetings, they considered hiking interest rates, right? They are seriously considering hiking interest rates. Reason being is because inflation is just not coming down in that country, right? So you've got a few different different inflation metrics. What the central bank look at, they prefer to look at the trim mean CPI, right? So it's slightly different calculation, right? It's like normal CPI and core CPI. Really, it's just kind of a slightly better gauge of the more broader. Or inflation across the more broader economy. But if you're ever unsure about what any of these mean, this is why trading economics is good. You see inflation rate, total rise in the price of goods and services. Okay, that's fine, right? But trim mean is clearly something different, right? So go and click on it and figure it out, right? Trim mean CPI, what's that, right? Click in it and you can scroll down a little bit, right? And in Australia, the trim mean is calculated as the weighted mean of the central 70% of the quarterly price change distribution of all CPI components, with the annual rates based on compounded quarterly calculations, right? So it shows you the calculation that goes into it is slightly different, right? It's more of an average kind of thing than it is just straight up figures, right? And again, anything else you want to go and have a look at, then go and have a look, right? So again, another reason why CPI out of Australia is super important, especially for Australia, really for Australia, is due to the fact that it is a quarterly figure, right? They don't get a proper inflation print every month like most of the rest of the countries do. They get quarterly figures. They do have this monthly CPI indicator, which is a monthly number, but ultimately they take the quarterly figures into consideration in Australia, right? And the fact that they're saying inflation is too high, considering hiking interest rates, if that goes and beats consensus, they will they'll have to look a lot more hiking interest rates. If that comes in and misses consensus, it cuts them a bit of slack, right? And they don't have to go and hike interest rates like they previously were thinking, right? They still won't completely remove them off the table, but that'll be a step in the right direction for Australia, right? Best tradable opportunities from us, or for us, come on a beat, right? Most people aren't going to be awake at 2:30 in the morning, so you might not be able to catch that. when it might not be able to catch that when it happens, but ultimately is something that we can look at after the fact and then see if they go and let's see if markets continue to run with that in the coming days and weeks ahead. Right, you then get manufacturing PMIs out of China. Right, they are likely to take a bit of a backseat, but it's still manufacturing PMI out of the world's biggest manufacturers. Right, when you look at those manufacturing PMI, and that kind of goes in line with Australian data. So if these manufacturing PMIs come out strong and Aussie inflation comes out strong, that should be guaranteed upside for the Australian dollar, and it's something that is likely tradable past that. Right, then you've got the first of the two central banks on Wednesday. Right, you have got the Bank of Japan. Right, so the Bank of Japan with their interest rate decision, but they also have their quarterly outlook report. Right, so the fact that they're releasing a quarterly outlook report means that we should get some indication as to what they are thinking in terms of interest rate hikes. Right, when are they going to hike interest rates again? If are they going to hike interest rates again? Right, they've talked about it, they've intervened, they've done all that sort of stuff, but the way to actually fix the problem that they have is to hike interest rates. Right, so the markets will be looking intently, right, and anything other than a confirmation of an interest rate hike to come is going to probably be looked at negatively for pricing of the Japanese yen. Right, the market thinks they should, and in reality, they probably should talk about interest rate hikes, and the debt to GDP levels in that country make doing that slightly troublesome. Right, so, but again, that's maybe a conversation for another day. Right, but the Bank of Japan, we're looking towards an interest rate hike from them. Do they clarify they are going to hike interest rates again, or do they decide to avoid that line of questioning? Right, consumer confidence figures then from Japan. Don't bother with that. I don't worry about that. Not much for us to really see there. Inflation then out of France. Now you got inflation out of France. I guess probably likely to take a bit of a back seat. Inflation is back at a more manageable rate. Previous to 2.2%, consensus 2.5%. Right, yeah, a tick up to 2.5% is not what they want, or is not what Europe wants, but ultimately 2.5% is not too bad. But again, like, take a bit of a backseat because inflation in the Eurozone expected to fall. Core CPI is still a little bit elevated, up at 2.8%, but below that 3%. So doesn't mean for a string of interest rate cuts from the Europeans, but at the end of the day, it's not bad enough to even consider interest rate hikes. So that'll then bring us on to a little bit later on in the day. This ADP employment change is something that's looked at quite heavily on NFP week, but that is, so non-farm payrolls is the public sector, right? ADP is the private sector, right? So it's not really a front runner for NFP. Sometimes it is, sometimes it isn't, and then if it only sometimes is and sometimes isn't, that means we can't really look at it as a clear indication. Right, that'll then bring us down to, well, we'll have oil inventories on Wednesday. You always get oil inventories out on a Wednesday unless you have a bank holiday in the US, so that is something to keep an eye on for the price of oil. But you've then got the Fed 7 o'clock on Wednesday. Now, they are not going to cut interest rates at this meeting. Some market participants think they should. I don't completely disagree with that line of questioning, but I don't think they will. Right, they don't like surprising markets like that. Jerome Powell likes to sit on the fence with a lot of things, right? But markets have fully priced in an interest rate cut for September, or at least nearly fully priced in an interest rate cut for September. So we'll have to see where that goes on Wednesday. Do they confirm or deny an interest rate cut in September? They'll probably say some nonsense like they're sitting. They're waiting for incoming economic data. They still need a little bit more to kind of to and fro a little bit, and not actually fully confirm the interest rate cut in September. Or if they do go and confirm it, then that should be pretty negative for the US dollar. So again, we're not really expecting. Personally, I don't really expect anything one way or the other from this on Wednesday. Right, we're looking towards forward guidance about September. As I said, markets have pretty much entirely priced in a cut for September. So the markets are pricing that. The Fed like to look at what markets are pricing. Therefore, it becomes Comes relatively easy for them to go and confirm that. But come on to Thursday then, again, it just keeps coming, right? Manufacturing PMI out of China, slightly different calculation with the Shin, I believe it's pronounced. Again, I'm not going to focus too much on that because you got the Bank of England on Thursday, right? So expectation consensus here is for 5%. Now, I don't think that's a full blown. It's not a complete certainty for an interest rate cut from the Bank of England on Thursday. You know, market pricing was more than 50% chance of no cut, you know, just a couple of weeks ago. So it's certainly not a foregone conclusion. They haven't really talked to us a lot in the last number of weeks. For the month or two leading up to the election on the 4th of July, they said that they weren't going to come out and talk. They didn't want to get involved in anything political, which is completely fair enough. Haven't really said too much of it to us since then either. So again, you know, people voting for a cut expected to be 5 and 9 and 4 and 9 for it to be unchanged. So you can see it's a bit of a hung jury on that one. Where 5 out of 9 think cut, or that's what consensus is supposed to be. 5 out of 9 for a cut, 4 out of 9 for it to be unchanged. So that is by absolutely no means whatsoever a foregone conclusion, right? So the Bank of England, right, whether they cut or whether they do not cut, neither one of them are fully priced in, right? So you are pretty much guaranteed, or certainly in my opinion, pretty much guaranteed a move one way or the other on the Bank of England on Thursday. Right, so we had all of you guys trying to trade a couple of releases last week that didn't pan out. Bank of England surely is a tradable day to release on Thursday. Right, that webinar will start at 10 to 12. It will start, or probably quarter to 12 actually. Give us a little bit of time to prepare on Thursday, so it'll be slightly different time, but we will communicate that as and when we get to it. Then you come to the manufacturing PMI on Thursday again, 3 o'clock. Now, the last one was pretty negative for the manufacturing PMI. 48.5 was the last figure, expected to be 48.8 here. Manufacturing PMI's consensus on the last meeting was above 50 and it came in 48.5. So pretty bad last time around for the manufacturing sector. Right, we had the S&P manufacturing PMI last week. That wasn't great either. So it'll be interesting to see what these have to say on Thursday. Is it negative again? If it is negative again, well, I mean, suppose we're going to have to really make an assumption or make a prediction on that after we see what the Fed have to say on Wednesday. That's kind of similar then for NFP. Again, it just doesn't stop this week. We've got non-farm payrolls on Friday again. Now with non-farm payrolls in was it 11 of the last 15 months or was it 10 of the last 15 months? Definitely double-digit figures. I can't remember exactly which one of those two it was, but the majority of the time over the last 15 months, right, what you've got is you have had a beat on consensus on the NFP print, right? But then you've had the previous figure revised down. Now, if that happens again and you've got this 206k figure and it's revised down 50,000 or 75,000 or even more than that, like it has been previously, that's pretty bad for the labour market, would show continuing weakness in the labour market. Right, this unemployment rate has risen up to 4.1%. If you just have a bit of a step back at a few releases, it's gone from 3.7% in January, right, to 4.1% in June, right, and in March it's gone from 3.8, then to 3.9, then to 4, then to 4.1. So it's consistently risen over the course of this year. That comes into 4.2. That would be further weakening of the labour market. Surely isn't good for the US, right? So again, there's a lot of things out this week to cover, to go through. We will talk about them in more detail as we go on through the week, but yeah, with these data releases, there are some tradable opportunities, and best of luck out there if you try and trade some of these. But yeah, that is a bit of a rundown of the week and what we're expecting, or certainly what I'm expecting over the course of this week, right? In terms of the economic calendar, right? Then once you've got past the economic calendar, what you've got is earnings, right? You have got earnings this week, right? So today you've already had McDonald's, right? You've had McDonald's out. McDonald's earnings wasn't great, right? Let me change that a bit. So you got McDonald's, but you've got some big hitters out over the course of this week, right? Four of the magnificent seven, they call them. You got Microsoft after the close on Tuesday. You've got Meta after the close on Wednesday. You've got Amazon and Apple after the close on Thursday. So some big hitters out over the course of this week. You know, you couple that with everything else you've got going on with three central banks, with non-farm payrolls, you know, with big companies releasing earnings. You got an action-packed week, and you can't forget these things. So it's easy to look at the Fed, easy to look at the Bank of Japan, easy to look at the Bank of England, easy to look at non-farm payrolls, and then forget earnings. But you've got some big companies releasing earnings, and you know you've got massive weightings across the different stock indexes. You know, some of these, you know, you look at Apple and you look at Microsoft in relation to the Nasdaq, there's like 25% of the Nasdaq just in the two of these. So with the stock indexes, these are going to have a big impact on them over the course of this week. And you know, some earnings from some companies haven't exactly been stellar. I mean, Tesla hasn't been great. McDonald's wasn't great. Tesla last week wasn't great. Alphabet wasn't fantastic. I mean, it wasn't bad in Alphabet, but it wasn't great. You know, you look at McDonald's today, it wasn't great. Bad growth outlook. Yeah, Microsoft, Meta. If some of these big companies start posting negative earnings, that is not good going forward, and is something we need to look at. So, not something that's as commonly traded, the actual data releases, but as these numbers come around, got to take them into consideration for your analysis throughout the week. But